What's up, traders and investors? I've been traveling the last couple of days to get to vacation. And one of the things I've noticed in hotel rooms, in the lobbies, and where I'm getting continental breakfast, which I love, is the wall to wall coverage of the Ukraine conflict, whether it's CNN, MSNBC, or Fox News. Every single expert on these programs want everyone to believe that World War III is imminent. Putin is crazy. He's going to go crazy, and it's going to send the market lower and lower. And if you kept watching these things, you're probably confused as to why the market over the last several days has rallied in spite of all of this crazy FUD, fear, uncertainty, and doubt. Well, if you're confused by this, if you've been following the news, I want you to stop. I want you to stop watching the news. You're not being informed of useful information. I'm serious. And you may say, well, if I stop watching the news, how am I going to be informed? How am I going to make good investment decisions if I don't know what's going on in the world? There is a much better way to get market sentiment information and even time the market bottoms by just looking at a objective representation of the fear that is in the market. What I'm talking about looking at is the volatility index, the VIX. This is a great tool that I've used for many, many years to get a true representation of what the stock market is doing. The VIX symbol, is the implied volatility of the S&P 500 ETF, SPY options. When the market goes down, fear rises. People want to buy protection. So the price of options goes up. This is what makes implied volatility rise, and that is measured by the VIX volatility index. And by looking at where the VIX tends to rise to points of panic and where it stops rising, this can be a way to time the market. It was very clear to me in the last couple of weeks. I've been posting on the Discord the opportunities that have been coming about for me just looking at the VIX volatility index. And I want to share this with you all so that you can take a step back from all the crazy news and find actual objective information that you can use to time the market. And we're not going to use any fancy technical analysis. We're just going to look at the VIX compared to the SPY. Let's start by going back in history to the COVID crash and see how volatility behaved then and how we saw the same thing happen over this last quarter one, 2022. Let's go to the trading view charts. On the left is VIX, the volatility index. On the right, I have SPY, which the VIX is based on. And we're going to use the replay fixture to go back to the last all-time high before the Corona crash. If anyone can remember that time and period, before we knew there was this pandemic virus. Remember 2 weeks to flatten the curve? Yeah, this was in there somewhere. All right. So here we are before we knew anything was wrong. Market was going up and to the right. Everything was hunky-dory. We had a little dip here, January 31st, 2020. And you can see that on the VIX. The dip on January 31st, 2020, down to about, let's call it 322 SPY. You can see where the VIX makes a spike up. That's what happens. The VIX is inversely correlated to the SPY. SPY goes down, VIX goes up. But the VIX tends to make these spiky moves and then quickly falls back down. And right before, as we were at all-time highs, the VIX was in the teens, 1483. That's a normal bull market type of VIX number, is in the teens of volatility. And you can notice on this January 31st, 2020 dip in the VIX, this high, which was about 20 on the VIX, didn't really exceed the high of October of 2019, which was much, much higher. There was more volatility in 2019 than there was in 2020. And so that VIX was not really higher. There was not as much fear. And so quickly, the market rebounded off of that January 31st low. Now, let's look at what happened as the coronavirus panic started to ensue. So, as things went down, you had a big down move on February the 28th. And so, what you can see if we watch in the VIX, as that was going down, the VIX goes higher and higher, really going crazy, making all time highs up to a value of 30. And then on that day in particular, that we looked at the 28th of February, VIX was all the way up to 39. So that is a very, very high VIX. In fact, it broke the high of 2019. And at this point, because the VIX, because the fear is so elevated, now you actually have a reason to believe that this is a true bear market. Because your fear is getting higher and higher. People are panicking. And so the stock market is going to keep going down. That's what you can infer as the VIX makes higher highs relative to the past. Now, we got a little brief reprieve, little pullback in February up to March 3rd. And of course, the VIX as well, it also pulled back. But if we go forward a few days on the VIX to March the 6th, and we look at March the 6th on the SPY, actually, let's go back one. Here's March the 6th. Notice a key difference. The VIX made a higher high, got all the way up to 54 on March the 6th, whereas the market came down and did not make a lower low. So you have a disconnect here. The VIX is telling you there's more fear, but the price of the market was not. So which one's going to be more accurate? Well, we know the answer. We know that the market continued lower, and that higher high on the VIX indicated that it was going to go even higher still. Now, if we watch the VIX, every day, just about, it's making a higher high until we get to the point of March the 19th. Now, March the 19th of 2020, let's find it here, March the 19th. Match these up. The market actually made a little bit of a dip as well. And then slowly, we had a nice dip in the VIX right here on the 24th. That was when we had that first rebound. I remember going into the store and they had oatmeal once again. And I kind of thought we might have a bottom. I was kind of tongue-in-cheek joking, but that was when normalcy began to return. And one of the key things to measure here on the VIX is the whole move itself, from the start of it to the high. The key line in the sand here is 49.70. So once you had VIX, the volatility index, finally push below this halfway point of the huge panic, that's when you need to start getting long. And so basically from the point of April the 3rd, here, where the market is not giving you any kind of real indication it's going up, the volatility index was telling you this panic is beginning to abate. And that moment was when you should have been looking to try to get long the market. As the fear began to abate, sure, there were a few more instances, like in June of 2020. In June of 2020, I'm absolutely certain that the media was reporting that there were more infections or more deaths or whatever the FUD was, but the VIX volatility index never even got close to a danger zone, never even recaptured the fear that was in the market in March. And the market just kept on going higher. Looking for the VIX to start to fall off, making differences in highs, is a key signal that lets you not read what's going on in the news to really know what is the market pricing in? What is the real fear in the market? Now, let's take a look at the current time period. There's a couple of key things here that I want to mark. So let's start before anything was really amiss, January the 4th, 2022. VIX was, again, bull market normal 16. That's in the teens. We have this move down to the 24th, which was fueled by interest rate fears, whatever the media was reported on, and the VIX made a high of 39. Keep that in mind right here. And that was the low of January the 24th. Now, February the 24th was when Russia invaded Ukraine. The market, both the SPY and the NASDAQ, made new lows. The correction continued. But something very interesting happened. I want you to look at this. The VIX told you it was not higher. The volatility index, the true price of fear in the market, had not broken the January 24th high. There was not higher implied volatility. There was not actually more fear in the market. Now, we had one last gasp on March the 8th. And actually, March the 8th on the NASDAQ made a little bit of a lower low. March the 14th. But again, this high on the VIX on March the 8th was going lower. There was not actually more fear being priced into the market. So while the media was reporting on all the bad things going on in the world, all you had to do was look objectively at what was the market actually pricing in. And then a thing happened on March the 14th. You have this little move down in the VIX coming off the highs here, pulls down to a low, this rally right here. March the 15th pulls up to 33.18, and that level was the highest the VIX went. And from that point, we have the rally, we have this fall in volatility, and all you needed to look at was the highs of the VIX going lower. If this was really going to be a major cataclysmic 30 to 40% correction, the VIX would be telling you first. It would tell you with higher highs. It would tell you with higher lows. It would be giving you a signal before that expert talking head on the news was going to tell you. I really want to hammer that point home because I hear so much of this FUD, and it's not really useful. All this was going on in the VIX that I was watching and trying to tell people about, either in Discord or on TradingView. Like, these are opportunities. Now I've been talking to some people where we're sitting here after 6 bullish days in the market. I'm making this on March the 22nd, 2022. We probably could get a pullback here at some point, but a lot of people are starting to believe that, oh, wait, this might have been just a correction, and now they're looking to get in. The reality is the best opportunities of this quarter of this year, 2022, may have been when everyone was watching the news, and you should have been just watching the VIX. So watch for this going forward. In the next market correction, market dip, just bring up VIX and see where the highs are. Is it really, really pricing in a true event, or is it just some mess that the media made up to explain the latest correction? Trade We'll see you guys in the next video.